What's the right mix of pre-tax versus Roth money in retirement? Some people say you should aim for a 50-50 split, and others say you don't want more than a couple 100,000 in pre-tax retirement accounts. Otherwise, those RMDs can cause problems. But I've got bad news. There's no simple rule to live by, and trying to oversimplify this can actually cost you a lot of money, maybe thousands or more in taxes. That's money that could have gone to a dream vacation or to your loved ones or just to a safety buffer in case things go sideways. I'm Justin, and I've been a financial advisor for over 20 years, helping people think about their retirement. In this video, I'm going to show you something better than just a rule of thumb. It's a way to think about your mix of assets and what to do about it so you don't have to wonder if you're doing it wrong. Here's the deal. The right mix just doesn't exist. It depends on your details. What opportunities do you have? What are you trying to do? That sort of thing. And we really crave simplicity, but in this case, you can't have it. Now, you do want some type of mix that gives you some control over when you pay taxes and how much. Enough pre-tax money to use your low brackets and enough Roth money to stay flexible when you want a lot of income. When people ask how much they should have in pre-tax versus Roth, what they're really asking is, am I going to get blindsided by taxes when I can least afford it? That's a fair question, and your optimal mix of pre-tax versus Roth isn't just about how much is in each account, it's how you can use it in the years you have. What opportunities can you take advantage of? A good mix will give you control, letting you control what you take and when, and then even affecting things like which income tax brackets you go into, how much you pay for Medicare, and even how much of your Social Security is included in your taxable income. The first lens I use is, can you take income at attractively low income tax rates? This is where Roth conversions come in. If you can convert at 12%, that's often an attractive range, and even in the low 20s might be appealing. Why is that? Because you're paying taxes now voluntarily at rates you can live with before RMDs begin, which can push up your income, and your Social Security income comes in, which also brings up your taxable income. Or maybe you'll pay taxes at a similar rate, but these conversions or withdrawals can still work in your favor because it's not just about the federal income tax brackets. Remember that more income can cause you to pay those IRMAA surcharges, which means more per month for your Medicare coverage, or make more of your Social Security taxable, among other things. So if you can preemptively fill up those lower taxes, especially before RMD time, then you may be better off later. What you're really doing here is smoothing out your lifetime income and the taxation. If you can convert at 12% now and avoid paying at 24% later, then that's a win. But as you move higher, say into the mid-20s or 30s and beyond for some people, then you really have to be more thoughtful about what you're doing. Maybe there's a good reason. Maybe it's managing RMDs. Maybe it's for the next generation. Now, with this approach, when we're talking about taking income at attractive rates today, you're not even looking at the future. You're not looking at what your mix will be or once you reach retirement or throughout retirement. You don't care about that. We're just looking for openings today. Is there something you can do? And you're ignoring the future to some degree. And I think that's okay. Next, here's the scenario that everybody worries about. You're living comfortably on $60,000 a year. You're 80 years old, but the IRS requires you to withdraw $200,000 out of your pre-tax accounts. Not only are you paying tax at relatively high rates on money that you don't really need, but your Medicare costs have also gone up. This isn't meant to be alarmist or scare you, but you do need to be aware that RMDs do exist, and sometimes they can cause problems for some people. So another way to think about your mix of pre-tax versus Roth is to try and match your RMDs to the amount you want to withdraw or up to some acceptable income tax bracket. If you pull that off, then the RMDs, or the amount you must withdraw, will more or less match the amount you want to withdraw in the future. The thing is, getting your RMDs down to the level that matches exactly what you want might be painful or just not feasible. The idea sounds great, but it doesn't work for everybody. Still, it's worth exploring to see if it makes sense for you. Now, if you have a substantial amount in those pre-tax accounts, then you might need to get more aggressive and use additional strategies beyond just Roth conversions. Or you just accept that you'll have a high income later in life. It is a nice problem to have if you think about it. It makes you fortunate. To manage those RMDs, some early planning can help, even if you start doing small Roth conversions in your 50s or 60s. Then, if you have a few low income years before Social Security and RMDs begin, that's your window. Then you can really do conversions, take withdrawals, whatever it takes to shave away at those balances. You can also look at QCDs or qualified charitable distributions at some point in life. Just remember that tax planning isn't a one-time event. You can make some smart decisions today, do what makes sense right now, and then revisit things down the road. Not just, try to pick a mix that you're going to keep throughout retirement. And if you're concerned about the so-called widow's tax trap, then run all your numbers for a single taxpayer and see how it looks. Now, I have worked with some families that just converted everything. They got all the money out of the pre-tax accounts. And that's something you might see with people on the wealthier end of the spectrum. But they still have Social Security, they still have income from taxable accounts, bank accounts, so they're not living tax-free. I don't think paying zero tax is the right goal, but you can do what you want. Typically, these people are doing it for the next generation, which brings us to the next framework. Assuming your own plan is in good shape, then you might be thinking about what happens after you die. Maybe the money goes to your kids, nieces and nephews, etc. And sometimes it makes sense to convert aggressively, even when it doesn't benefit you directly. If your heirs are in higher tax brackets or they'll have to withdraw under a 10-year rule, then paying those taxes for them might be a nice thing to do. It might or might not be the optimal thing, but if you've got plenty of money, plenty of cash flow, then it's worth considering. But don't just do it blindly. If they'll be in lower tax brackets than you, then maybe you're just burning tax dollars unnecessarily. Run the numbers and see when it makes sense for somebody to pay those taxes. Now, a lot of people just think they should convert everything to Roth. It really does sound great in theory. Tax-free growth, no RMDs, total flexibility. But in practice, that can backfire. You might pay far more in taxes than you ever needed to. Remember that you get a standard deduction each year. Plus, you can probably take income in the 12 and 10% brackets at some point. Remember that you get a standard deduction every year. Plus, you can probably take some income in the 10 and 12% brackets without much pain. And we don't know what policy decisions will be or how tax rates will work in the future. A healthy mix helps you take advantage of all of those brackets and allows you the flexibility to take income from different buckets depending on what each year brings. But the right mix, it really comes down to your plan. Are you going to spend down some assets? Are you worried about RMDs? It just depends from person to person on exactly how all of that's going to unfold. I hope you found that helpful. If you did, please leave a quick thumbs up. Thanks, and I look forward to talking with you soon.